Hey everyone, this is Ryan Mallory for SharePlanner.com. Today is May 15th, 2014, and wow, what a day that we're having in the market. And 3 days ago on Tuesday, I don't think anybody really thought that this would happen. At least not in the initial going to Tuesday. Definitely not on Monday. There is some precedent for it, and I wasn't sure if it would really play out so perfectly like it is today. And that is going back to early April, where we broke out to new highs, and then we consolidated a day, and it looked like, okay, the market's just taking a breather, and then we had this huge sell-off the following day. Well, now we're getting the same exact thing again, where we're just selling off extremely hard, and that's just like what we did back on early April, where we break out to new highs, almost pushed the 1900 level. This time around we do break through the 1900 level, but we can't hold it intraday, or we can't hold it into the close, but we can hold it intraday. And then we have this evening star pattern that formed yesterday, which made me a little bit queasy. I ended up adding a short position to the 4 existing long positions that I had, so I had 2 shorts and 4 longs. And then today we've just seen that follow through come right through, and there was favorable reactions early on to the jobless claims report and to the some of the other reports that came out, but it just didn't hold. It was just really a momentary blip, and you had bad earnings from Walmart, which apparently is weighing heavily on this market. And going forward, I think it's really hard to get short at this juncture. I know a lot of people probably think that would be the wise move to take at this point, but I really don't see how that's the best thing or the wisest move to make. You can see here we had a 2-day move after we consolidated. We consolidated on Tuesday and then have a 2-day move followed by a heavy bounce, followed by another 2-day move and then an extreme bounce. You date back to this market, over the last 3 months that we've been in this consolidation pattern, and it's consisted primarily of 2-day sell-offs followed by a bounce, 2-day sell-offs followed by a bounce. And we're in that 2-day sell-off point, and to me at this point, to get short on a market that has seen dip buyers come in time and time and time again, it doesn't really make that much sense for me. So I'm going to be very hesitant to get net short on this market. My short position yesterday was in Wendy's, and I got in at it like at 18.19, and so it's at 18.05 right now, down about 1.6%. I got in right before the close yesterday, and it's a great looking chart and everything, but it's also a very, very bearish stock over the since February, basically, when it hit new highs. It's just been selling off since. So it's bearish regardless right now if the market's bullish or bearish. It's pushing lower outside of the fact of whatever the market's doing. So that's the kind of short that I targeted for yesterday. I wanted something that even if the market popped 150 points today, which clearly it's not, this stock probably wouldn't pop 150 or wouldn't pop 2 or 3% with it. So that's my basis there. Now I got out a tell, and this raised some eyebrows in the chat room, because obviously at that point of the day we were down like 3 or 20 points on the S&P, and I get out of it. But a lot of the reason goes back to looking at these pivot points here. There's no like magic or mysticism to it, but it really helps to understand the capability of a stock's movement in a given day. Most of the time you won't see a stock venture out of the S3. Most of the time it's going to be between the S1 or S2 or less. Okay, that's in a given day. That's usually and into the upside it's R2 or less. So it's going to be between those two price levels that are reestablished each day based on the previous day's price action. And here today you got TEL that's just, and we've held this one for a while. A long time. I think we bought or shorted this one back on the 8th. So for this kind of market, a week's a long time, and we got about 2.5% off of it, and it was clearly way below this S3 level. So at that point, you have to ask yourself, what are you really trying to get out of this stock at this point? Are you trying to get another percent? Are you really thinking that it can drop 4 or 5 more percent? Maybe this market drops tomorrow, and this thing continues to drop with it, and so be it. But it's heavily oversold, and you know, you got to be aggressive with the gains in this market. That's the one thing. You know, when you get when you get stock that fortunately can get you like 3 or 4%, you know, in a couple of days. You got to book those gains. You got to be aggressive with them. You got to seize the opportunity. So here we have like TEL. We've had it for about a week, and it's given us about 2.5% to the downside. It held up well when the market broke out to the upside. So I'm really trying to capture those gains. Let's see here. Bear with me 1 second. Trying to do 2 things at once, so sometimes I'm not really a good multitasker, so I have to focus just on one thing. And okay, so I was talking about TEL and why we took the gains in that, and then we talked about Wendy's WEN. Now let's go back to the S&P 500 here, because I haven't said everything I want to say about that yet. So there was a question in the chat room today. Why am I buying stocks this morning? Why did I cover 1 short and buy 2 more stocks? And you know, obviously that can either work out to my favor or not. You know, that story or that chapter is yet to be written. But there was some very solid reasoning for what I was doing. We talked about the pivot levels, right? I started covering in my shares in TEL and started buying 2 other stocks well after the S&P was well below this S3 level. So that doesn't mean that it can't keep going down lower. It just means that there's probably a higher chance that it's going to bounce some before. Let's break it down into really simple terms. There's probably a better chance that it bounces 10 points at this point than it does that it drops 10 points at this juncture. So to me, to get short on stocks after the S&P is already well below the S3 level on those pivots, not a good idea. And then, but I wouldn't base say getting long. The pivot levels are going to say, okay, don't you know, start adding heavy to the short side here. Don't do that. That's what the pivot level is going to tell me. But then when I start looking at some of the price action and what we have seen of late, that's what sort of got me to go pull the trigger on the long side. Now, for GLW, I started getting interested in it when the market was just a shade above this 50-day moving average and it was holding on to this trend line. Obviously, at this point, it's dropped some since then. It's gone from, you know, 1868 down to 1864, but that really doesn't bother me too much. For one, we've not seen any significant bounce out of this market yet today. Most of the time, you're going to see at least a bounce. Now, we had a heavy sell-off back on I think it was, yeah, 5-6, and we didn't see any bounce on that day, okay? And maybe that's how this one plays out. But, you know, I'm looking at the odds here. I'm looking at where's the risk, where's the opportunity to trade this market, and sometimes there isn't the opportunity. But here, what we have seen time and time again is that after 2 or 3 days, usually just 2 days, of where the market sells off, we get a bounce. We get a bounce of some kind. So maybe that doesn't happen today, but then we're positioned tomorrow if that bounce comes tomorrow. But you can see here, you know, we bounce. I mean, I remember this day very specifically on 428 because it looked like the bottom was falling out of this market. And I remember it here again on 415. This was a wild day in the market, but we've seen it here on 415. We've seen it again on 428. We've seen it again on 5.7. We've seen it again on 5.9. And so the likelihood is we're probably going to see this happen again because the dip buyers, they are very predictable, okay? They like to buy the dips, okay? That's why they're called the dip buyers. And I don't doubt that they're probably going to do it again here. The biggest risk is, okay, maybe we go lower before we see that dip buying, but the dip buying is like being addicted to crack cocaine, okay? You just don't go cold turkey off of it and say, okay, I'm not using crack anymore. And just as a disclaimer, I've never done any crack before. I've never even done drugs before. I know I'm pretty lame, but oh well. But you know, the drugs are addictive, so you don't just get off of drugs just on a drop of the hat just because you want to. I mean, there's relapses and everything else. So for dip buying, they're not these program buy machines and the hedge funds and the algorithms that that take advantage of these things. They're just not going to stop dip buying out of the blue. Okay, it's worked too well for them not to. Okay, it's worked here where you saw, geez, what was it? 1, 2, 3, 4, 5, 6 straight days of rallying. Here again, 3 straight days of rallying. Here again, another 3 days of rallying. And we're not talking about small rallies. We're talking about very big rallies. And you know, the opportunity for the dip buyers is that, okay, it's at 1864 now. In 3 days, it could be 1890 or breaking 1900 again. Okay, that's the power of it. And so, what it does is it snags you into these squeezes that, if you're short, you're just going to help push these markets higher, aid the dip buyers. So, the best trade in this market has been to fade the moves, okay, particularly to the downside. And for the last 3 months, it's been like that. It has been very difficult. It has been very difficult for traders to profit in this kind of market, because it's not so much that you can't make money in a bull market or a bear market. It's just that it's difficult to trade in a market that looks like this, where you're just going up, down, up, down, up, down, up, down. And when you think you're up, you're going back down. And when you think that the market's going to go down, it's going to go right back up. And that's where people get themselves into a lot of trouble, over trading and just ruining themselves from a capital preservation standpoint. So now that I'm done with the SPX, let's just do some cursory looks at RUT. You could see this. I mean, it had a really good 2-day bounce followed by a 3-day sell-off that was just unmerciful. 40 plus points to the downside. It's making new lows on their downtrend now. So, and you can see too, when it's sold off, it'll make new lows, but it doesn't make significant new lows. So there, another reason right there to bounce. Oh yes, I didn't mention this on the SPX, but I still want to. Maybe I did. I'm just already forgetting that I did. But this 50-day moving average, every one of the bounces has happened when we've tested the first time when we tested that 50-day moving average. Of course, we're testing it for the first time again, and that's probably another reason to think that we may see a rally into the close. All right. We just talked about the Russell. DJIA just made all-time highs the other day, and now we're down 212 points on this index, and it's testing the 50-day moving average. And as you can see on this DJIA, the Dow Jones, it's tested the 50-day average the last 2 times very successfully, and has popped as a result higher. NASDAQ. I honestly don't like the NASDAQ. Out of all the charts, I think the NASDAQ looks the worst, because you have this nasty head and shoulders pattern that could confirm if it drops back below 4,000. You got about 1% to work with there. So we'll see if that comes to fruition or not. But watch that 3,998, 4,000 price level on the NASDAQ, because that could get sort of ugly for that stock, and it would confirm right at the break of a 200-day moving average, which we have not broken since a long time, going back to 2013. Yeah, I mean, we tested the 20-day or the 200-day moving average back on 4/15, and we held it perfectly. All right, let's look at a couple of individual plays. Jumped into AAL today. Here's the reason why I did. Look at this perfect breakout level that it had last Thursday. It broke out. It looked like it was going great. We even tried or no, that wasn't with the AO. That was a different one. But this was on the watch list, and it didn't break out until last Thursday, and it came back down, and it's tested this level perfectly. So I decided to get in on that one when I saw it, bottoming out here on the 30-minute chart and on the 5-minute chart as well. I thought it offered a great risk-reward opportunity because at 38.16, it can probably get back into the high 39s, maybe even $40 here in the not so distant future. And then you got GLW, which we got into, and it really hasn't done much for us on the bounce side of things. It was selling off, was right at that S2 level, was holding up for the most part pretty well on the day, and then it just sort of took a beating with the rest of the market as it continued to sell off below the S3 level. It hasn't quite gotten to the S3 level on the individual stock, even though the market has, so it is still, I guess, somewhat holding up relative to the pivot points on both of the indices. But yeah, this is one of those stocks where you'd like to see the bounce come into play before the end of the trading session, and go from there. A couple of others to keep an eye on. PHM. This is an enticing chart too. You have a bullish wedge. It's broken out of the bullish wedge. It retested it, held its own. About to go green of all things. One of our stocks in the portfolio, EMC, has held up really well today, only down 1/4% or 6 cents. You can see here on the 5-minute intraday chart, you got an inverse head and shoulders pattern. You got the left shoulder, the head, and then you got the right shoulder there forming. And you also have a double top on the daily. So really good stuff going on there. It's trying to push back through that 20-day moving average. ADSK. That is not ADSK. This is ADSK. Similar thing to what we saw with AAL, GLW, where it's broken out and it's trying to retest that price level again. And then Core. Somebody asked Core, we got stomped down on this one. The question was, oh, would you get back into it? Or I really don't like it. I think that us getting stopped out at 91.31 this morning was a good sign that our trading thesis for being long on the stock is a bit flawed now. It wasn't able to break out like we thought it would back when we got into it on the 12th. And so you got to be careful with this one because now it's creating somewhat of a double top pattern, and I wouldn't get long on it. That's going to do it for today. If you have any questions, feel free to email me at ryan@shareplanner.com. Right now, I'm going to be focused more on the long side. I don't want to get short on a market that's already sold off about 40 points off of its highs. I think there's still some opportunity for the dip buyers to come in and push this market back higher, and as a result, I don't want to be caught short and be squeezed. I mean, I have some shorts, but I'm hedged with those shorts just in case I'm wrong, and we can still make some profit with the WEN short that I talked about earlier. Have any questions? Email me, ryan@shareplanner.com. If you're in the Splash Zone, always ask me questions in the Splash Zone. I'm always in there, and I love taking questions and helping out any way possible. And if you haven't joined the Splash Zone yet, definitely do it. It's a free 7-day trial. You get access to the chat room, obviously, the ability to automate my trades through Ditto Trade or one of our other partners. If you're not able to watch the computers all day long or react to my text or email alerts, which I also give out as part of the package. Y'all have a great day. Let's see if this market can't recover some tomorrow, and God bless you all. Thanks.